Welcome to my YouTube channel, a space for corporate and commercial discussions.
Of laws speaking. So today we'll be talking about strategies for private equity firms to leverage up. So the first is venture capital. So venture capital is a process where private equity firms invest in startups or companies that just at their early stage, like seeds that are germinating. So invest in companies at their senior stage. So when they are just coming up, when they just become an idea that are willing to be established or to be expressed. So the venture capital is the first way you invest in those companies at that early stage. However, strategy of venture capital is actually a lot risky. So in process whereby when you invest in companies that are just at their early stage, you don't know whether the company has a potential for growth. They might end up growing, they might end up failing. So when they fail, you are the loss. When they grow, you are still you are the benefit actually. But it comes with a very, very, very high risk. The second one is growth equity. Unlike venture capital, where you invest in company at a very early stage, in growth equity, it is you investing in company that is established already but needs capital to expand. So I get so in growth equity, to recapitulate, is when you invest in company that is established for needs capital to expand. An example is when for instance is Moneypoint, when Moneypoint decides that fine, you have been a fintech company for long. Now we want to stop being a fintech, we want to start having a license of a traditional bank like the likes of TT Bank, Access Bank, and the rest. So what they do is, the requirement I think from CBN to become a traditional bank is I think a billion naira share capital. I think so. You should fact check that. So the requirement is at least a billion and some other certain requirements that will be provided by CBN and other relevant acts or bodies. So to become that, they need capital to expand. So what they do is they get partnership from private equity firms. So it will now be in the form of growth equity, where the capital is offered to them for growth, for them to expand, unlike venture capital when it is for them to terminate the idea. So and for growth equity, it's actually of a lesser risk than venture capital because it is expanded. Expressed. The idea is expressed. It just needs to expand it. So and what it was that could happen to in the third is buyout, leverage buyout. So this is when a company is underperforming or in financial trouble or certain financial crisis or underperforming generally. So the company is being leveraged and it is in buyout. The private equity can buy controlling interest in the firm. They keep it, they build it, they change management, and they keep it going. And sometimes they sell for profit. So this one is distressed debt. This is when a company is in the is under financial crisis and underperforming as well or on the threat of bankruptcy. So on the threat of bankruptcy, distinguishes it from leverage buyout. So on the threat of bankruptcy. So what it is, they buy the debt, they finance the debt, and they take control of the company, they change the management structure, they they work it around to in a way to increase the value of the company. And they sometimes sell for profit or keep. And sometimes they also sell to another private equity firm to also run the same thing, who also might end up selling out or end up selling to another private equity firm who also buy at the value, walk around, increase the value. So it works like that sometimes. I mean, sometimes it doesn't get the fact that it sell out and that's the end of the company. So, and those are the first common strategies for private equity generally globally. Thank you for watching. Thanks for listening to the end.